Realty Income's three biggest tenants are Walgreens, Dollar General, and Dollar Tree/Family Dollar. And what do all these three companies have in common? They've recently faced some very bad news, and it's not a good look for Realty Income. Hey everyone, this is Yus. I run a small investment firm that specializes in REIT investing, and in today's video I'm gonna discuss all stocks growing tenant difficulties. But before I get into it, I want to remind you that we just recently launched a new YouTube channel that discusses all our favorite non-REIT investment opportunities. So there we discuss other high-yielding vehicles like MLPs, closed-end funds, BDCs, and so on. We are now approaching 2,000 subscribers, and we just recently posted a video on some of our top picks for the coming years. I highly recommend you go check it out. I'll put a link to it in the description of this video. So let's start here with Realty Income's biggest tenant, which is Walgreens. They just recently announced that they were going to shut down up to a quarter of their stores as part of a company-wide strategic review, and this caused its share price to crash to a multi-year low. As a result, some analysts now fear that Walgreens could be going the same route as Rite Aid, which filed for bankruptcy protection earlier this year. This reminds me what Vichy's CEO told me in a previous exclusive interview that I had with him about pharmacies. He said that if you look at drugstores, you have to ask the question, once Amazon gets truly serious about being an online pharmacy, what's the impact on Walgreens and CVS? And we are clearly seeing it here. Walgreens is struggling, but also other pharmacies are facing growing difficulties. And it's not just because of online pharmacies, but also because of the high inflation, growing thefts, and as a result they are struggling to make money, and more of these properties are now shutting down, and therefore net lease pharmacies are now perceived to be riskier property investments. And unfortunately for Realty Income, it's not just Walgreens. Another one of its top three tenants is Dollar Tree/Family Dollar, and they just recently announced that they were planning to shut down 1,000 stores in the near term. More specifically, they are planning to shut down 600 Family Dollar stores to this year already, and another 400 company-wide stores. So these might be Family Dollar or even Dollar Tree stores in the coming years as leases gradually expire. We just recently also interviewed Agri Realty's CEO for High Yield Landlord, which is my REIT newsletter. If you want to check it out, I'll put a link in the description of this video for a 2-week free trial. And in this interview, we asked him what were his thoughts about Dollar Tree now attempting to sell Family Dollar, and his response was simply that, good luck, which really embodies the growing difficulties that the company is facing. Many of their stores are today losing money, they are stuck under long-term leases, they've been underinvested over the years, and now they are facing growing competition from Amazon and other offline retailers. One of their biggest rivals, 99 Cents, just recently filed for bankruptcy protection, citing inflation, theft, and shifting consumer demand as the main reasons for their demise, and Dollar Tree, Family Dollar are suffering from the same issues. And I'm still not done. There are also growing concerns over Dollar General, which is their second biggest tenant. Its share price has crashed by over 50% over the past 2 years, and the main reason for this is that their profitability has been crashing down, and an even bigger long-term concern of the market is that some of its competitors like Walmart could now be coming for its business. Historically, Dollar General has done really well because it has focused on less competitive, more rural markets. In our interview with Agri Realty CEO, he explains that Dollar General is the food supplier of rural America. It's literally the sole general store in areas with zero competition from other retail. They build at least 15-20 miles from the nearest Walmart and are an essential provider to rural Americans. And this was true in the past, but this could now be changing in the future, and this is causing a lot of concerns. Walmart and other big retailers are now developing smaller store concept and coming for rural America. And my fear is that because Walmart has far bigger scale than Dollar General, they have also stronger power of suppliers, which could allow them to offer better prices and bringing serious competition to Dollar General. Even then, I still expect Dollar General to do fine over time. It has a serious first mover advantage. The company is managed really well in my opinion, and it's gonna take a really long time for Walmart and others to develop their store count in these smaller markets. But still, I think that this is a growing risk, and it could lead to some lease cancellations down the line. The issue here is that from a real estate perspective, there's really little to like about these property investments. Typically, these are in rural markets with declining populations, or at best stagnating population. We all know about the urbanization trend. This is not going anywhere. And these properties are built very cheaply. Typically just cost $200,000-$300,000 to build a very simple structure, and these are really not built to last forever. In one of our previous interviews with Vichy's CEO, he compared their casino net lease property investments to the typical Dollar General property investment, and here's what he had to say. Caesar's Palace in Las Vegas was built in 1966 and is as vital as a building as ever. The Venetian was built like the freaking pyramid of Egypt. I mean, the asset will be there forever. You know, the Chinese use the term 1,000-year asset. Who knows if it's truly going to be there in 1,000 years, but this is what the Chinese mean by 1,000 years. Not to disparage the Dollar Generals, but those are built to last maybe 15 or 20 years, and then, you know what, knock it down and start over. It was cheap to begin with. And so to put it simply, the Dollar General properties are typically poorly located, they are built very cheaply, and so their value is very heavily dependent on the lease with Dollar General. But if you now lose this lease as it expires because, let's say, Dollar General is facing growing competition from Walmart in its market, or perhaps its real estate needs change a bit, it needs a bigger store because the property is doing so well in that market and it just decides to build another property across the street, then your property will crash in value because it will be very difficult to refill it with another company of similar quality as Dollar General. Therefore, these net lease property investments are considered to be much riskier than average, and it also explains why they typically trade at higher cap rates despite Dollar General having a strong investment grade rated tenants. It also explains why back in 2016, when I still worked in private equity, we would avoid these type of properties for the most part. So all of this is a pretty bad look for Realty Income. Historically, it's been perceived to be a higher quality net lease REITs, but today its 3 top tenants are struggling. But is this enough of a reason to sell Realty Income? And my answer here is no. Realty Income is very well diversified, it enjoys long-term leases, and on average its properties are still superior, which would reduce the risk of them shutting down as leases expire. But at the same time, this is not something to ignore either. Combined together, these 3 tenants make up about 10% of Realty Income's rental income, so it is meaningful, and in its top 20 tenants, it also has other companies that are facing difficulties. There is Red Lobster, which just recently filed for bankruptcy. There's AMC as well, which is quite potentially facing bankruptcy down the line, and there's also CVS, which is facing similar difficulties as Walgreens. I believe that this reaffirms my previous point, which was that Realty Income's average portfolio quality has degraded over the years following its many M&A deals, including the acquisition of NAREIT and Spirit Realty Capital. I just mentioned here that Red Lobster just recently filed for bankruptcy protection, while most of these properties came to Realty Income through its acquisitions of NAREIT. And the now lower quality of Realty Income's portfolio is also evident if you now compare its average occupancy rate to that of its other close peers like Agri Realty, WP Carey, Vichy Properties, Essential Properties Realty Trust, and so on. You'll see there that Realty Income has one of the lowest occupancy rates in its property sector, and its occupancy rate could decline further if it keeps facing similar tenant difficulties. Therefore, I think it's a mistake to compare Realty Income to higher quality net lease REITs like Agri Realty, and they really shouldn't be trading at the same valuation. I see a lot of bullish investors here make the argument that, look, Realty Income is even cheaper than Agri Realty. It's today trading at about 13 times FFO compared to 15 times FFO for Agri Realty, and they're making the argument that, look, Realty Income is relatively cheap and should enjoy some upside as it re-rates closer to Agri Realty. But I just don't see this happening. I think that the market was smart enough to recognize that Realty Income is now a lower quality REIT and therefore it deserves to trade at a lower valuation than Agri Realty. And in fact, I would make the argument that the discount here is not large enough because Agri Realty is really a higher quality REIT from every perspective today. I'll put a table on the screen and you'll see there that its tenants are far better in quality, it has less leverage, has fewer debt maturities coming its way, it's expected to grow at a faster pace, it's going to be less impacted by the surge in interest rates, and many other things. But right now, Agri Realty is priced at 15 times FFO, Realty Income has 13 times FFO, so a 2 turns low FFO multiple. But if you now adjust for Realty Income's higher leverage and lower property quality, so properties that typically would trade at higher cap rates as well, if you adjust for these 2 things alone, the valuation is actually more or less the same today. You could even make the argument that Agri Realty is actually slightly cheaper than Realty Income, and therefore I really see no point in buying Realty Income today. But to be clear, I still expect Realty Income to do relatively well over time. Today it's priced at a reasonable valuation, it's offering a 6% dividend yield. I don't expect it to grow as fast as Agri Realty, but it should still be able to grow at 3 to 4% per year on average, so the yield and the growth alone should get you to near double-digit total returns. As interest rates are cut, I think it will also enjoy a bit of upside, and perhaps this will also help some of its struggling tenants. But the point that I'm making here is that you can buy a higher quality REIT at a similar valuation in the case of Realty, and so I don't really see the point of buying a Realty Income. Realty has massively outperformed Realty over the past decades or so. We're not talking here about 1 or 2% per year. We're talking about very significant outperformance, and I just don't see any reason why this outperformance would end anytime soon, given that the valuations are similar. Realty has a better portfolio, it's growing at a faster pace, it's less impacted by the surge in interest rates, and so if anything, I expect this outperformance to even accelerate in the future. And so am I buying shares of Realty Income? No, I'm not. I would much rather buy more shares of Realty. And if you want to access our full interview with the company CEO, it's available freely at High Yield Landlord with our 2-week free trial. If you want to read it, I'll put a link to it in the description of this video. This will also give you immediate access to my entire portfolio, all my trade alerts in real time, and much more. Finally, if you thought that this content was valuable, please click the like button, subscribe to the channel, and if you have any questions about Realty Income or any other REIT, please let me know in the comment section below and I'll make sure to get back to you as quickly as possible. Thank you very much and see you at my next one. Bye-bye.